Hey, everybody. James Gaskin with the Hustle Harder Show, and excited to welcome you back. We have turned our calendars to January, which means a new season of the Hustle Harder Show is upon us. This is episode 1 of season 3 of the Hustle Harder Show, and we're super excited to be back. The team and I have been working on a lot of great ideas and some new things that we want to do for this season. We're going to be spicing it up with some different formats. You're going to see some new faces on here in addition to myself, some folks from Renovo that I think have great personalities and will be a great addition to what we're trying to do, and a lot of amazing guests. So it's really excited to be starting off a fresh year. And for the first episode this year, I decided to do a solo episode. So that's going to be a lot of me, but talking about, kind of what we saw from a lending perspective in 2025 as it relates to residential investor real estate. And then we kind of talk a little bit about some of the themes and trends that we're following going into 2026. So a little bit of, kind of recap of last year, preview of this year, and just some things to be thinking about. In this episode, I talk a little bit to real estate investors directly, as well as to the lending community or the lending industry that supports those investors. So a little bit in there for everybody. It's a little bit of, a lot of content in there, a lot of things to talk about. But I think some of the big highlights are, some of the rate dynamics. I think we're going to probably see pretty reliably, high rates. Maybe, not necessarily forecasting for rates to go up, but not seeing a ton of downside movement either. I think, it'll probably be a relatively elevated rate environment, certainly compared to maybe 4 or 5 years ago. The inventory issues, the supply demand dynamics continue to play out in different markets. We touch on that a little bit. And then I think going into 2026, I think we're going to have a bumpy year. The midterm elections are coming up. I think a lot of policy things are coming out of Washington and other places that I think we have to keep an eye on. Much like 2025, I think we're going to have a similar year in terms of some of the different dynamics. So excited for you to jump in and listen to some of the detail. We'd love to hear from you, what your thoughts are. If you have additional feedback or input, we'd love to hear it. And if you're enjoying the show, please like and subscribe. We'd love to have you in our viewership or listenership going forward. And like I said, we're really excited about the content this year and all of the things we're working on. And we're planning on putting out more content this year. So, hope to have you along for the journey. So with that, I will leave it to me to take it the rest of the way. Thanks a lot. Cheers. Hey, everybody. It's James Gaskin, and we're back for season 3 of the Hustle Harder Show. Could not be more excited to be back here. It's January 2026. I feel like last year was a big year for a lot of people, a lot of challenges. I think some success across our industry in real estate lending and for our customers, but definitely a lot of bumps in the road, let's say, a little bit of friction. And I think going into next year, maybe a little bit more of the same. But I wanted to start, this year, this is a fresh, kind of turn of the page, new chapter. And, we're really excited to really continue to evolve the show. It's been a lot of fun to do and a lot of fun with the guests. But I think we want to continue to push things and innovate and do things that are interesting and bring some value to you, our listener or our viewer. So we're excited to do that this year. You should see some new things. Hopefully, we're going to be releasing more content a little bit more consistently, which I think will be really good. And, we want to hear from you, the audience, about what you want to see and hear from the show and things that you find interesting. I enjoy consuming podcasts, and we're going to try to make this as entertaining and fun to be a part of for the listener or the viewer as it is to make it. So excited about all those things, but I wanted to start the year off. As we turn the page from 2025, I thought it would be appropriate to go back and take a look at, kind of what 2025 had to offer, some of the themes that I observed from my seat here at Renovo Financial and then, kind of what 2026 could look like. Kind of, my expectations or my thoughts. I am an expert in my own mind. I think I've been doing this for a long time, so, kind of know a little bit about what I'm talking about. But, these are my thoughts, not necessarily Renovo's thoughts. But, I thought it would be fun to kind of go through some of the themes and things that maybe we can look to expect for this coming year, and, maybe how we're approaching things. So with that, maybe we'll get started. And I've got my trusty Remarkable pad here. Shout out to Remarkable. I love these things. But I've got a bunch of notes here that we'll go through. So I'll reference that a little bit with you guys. But 2025, recap, generally speaking, I think we saw, some rate compression within the private lending space. We're focused on making loans to residential real estate investors, smaller to mid-market firms, typically doing anywhere from a couple projects a year to, 100 or a couple hundred in the single family space. And then, of course, we also lend on multifamily. Home builders is a new industry vertical that we're super excited to get into. So we kind of span all of those aspects, but primarily residential. And I think in our core business of lending to small balance, residential real estate investors, fix and flip projects, infill construction, buying an outdated piece of real estate, tearing down the structure and rebuilding something that's more suitable for today's environment. There's been a lot of capital coming into the space, a lot of institutional investor interest in what we're doing in the hunt for yield. A lot of investors have gotten all the way down to helping us finance these small, by their standards, projects. Certainly, these are not $100 million, skyscraper hotel deals. We're talking about 250 to, a couple $1 million loans for projects that are, typically single family in, kind of our historic business. And, a lot of interest in that space from the investor standpoint. And what that's done is it's pushed a lot of capital into the market. A lot of lenders that maybe in the past, had some friction in raising enough capital to meet the demand. That friction seems to have gone away with the kind of influx of institutional capital that's coming in through aggregators, loan buyers, and what I would call kind of financial institutions and private equity, hedge funds, et cetera, that are coming out and either acquiring platforms to lend out, the capital that they've raised, or to acquire loans or buy loans or what have you. So a lot of money. And what that's done is it's created an intense competition for the good deals that, are out there. And I think, 2025, we saw the environment for investors on the ground in some markets, not in all, but in some, the environment got pretty tricky. And I think, the more experienced, more well financially, capitalized firms were able to take advantage. Folks that were newer to the business didn't have as many reps, I think, found some challenges. Some may still be in the business. Some may be pivoting to something else. And, that's kind of the nature of cycles. But on the capital side, the cycle is definitely red hot from the investor perspective. So I think what that's done for the investor on the ground who's borrowing funds is it's created a lot more viable options probably, and very competitive pricing in terms. So, for your average fix and flip project, it's not uncommon for people to be going out and getting extremely high leverage loans that are, plentiful in terms of availability across different lenders. And, pretty, I would say very competitive pricing. All these lenders are fighting each other for the same deals. I would say that the pie of deals overall has gotten smaller, or it's at very minimum kind of stayed stagnant. So it's not like there's this robust renaissance in residential development that is creating a lot more opportunities for all this capital to go into. The money is really chasing what I think is either a stagnant or potentially slightly shrinking pie of really strong projects, but maybe more importantly, really strong sponsors. That's been a challenge for us as a lender because I think we do a lot of things extremely well, but in a market where everybody has money, that message can get lost a little bit in sort of the intense competition related to price and particularly leverage. So it's been an interesting year. We were able to, battle through that and overcome those challenges. We had a record
funding year, really a record on almost any metric you can imagine. That doesn't mean it wasn't difficult. And, we really had to work hard to push those levels, and we'll continue to do so. But again, I think a lot of the things we do well resonate with our customers once we get an opportunity to work with them and show them that we actually kind of do what we say we're going to do, which is not always the case. So that's been a big theme. And we'll kind of get into how 2026 looks here in a little bit. But I wanted to start with that because I think it was a big theme all around. One of the second big themes is, fraud and valuation challenges. There were a few pretty notable instances of, professional fraud in the space. Anyone who's in this industry, probably has heard about, a deal or a situation out of Baltimore that, caught a lot of lenders off guard. A lot of folks who, maybe had relaxed their concentration rules. There's a reason, if you're a borrower and you're doing a ton of projects, there's a reason that sometimes your lender will pump the brakes a little bit. And that's an effort to reduce the risk to the overall portfolio and the platform. If you have one investor who's responsible or who holds a ton of loans that are on your books, if that investor has some issue that you were unaware of, it can be very, very painful. So we create these concentration limits to kind of manage risk on our side. It's not because we don't love the client or we don't want to give them more loans for their projects or don't believe in them. It's that we're trying to manage risk. And that is one of the main, if not the main job of a lender, right, is managing risk on behalf of the investors who put capital behind you. So it's a big thing that we have to do. There were some lenders, I think they got, overextended with, a particular borrower. That borrower was going around and borrowing from a lot of different lenders in the space. Turns out, there was a lot of fraud in terms of the valuations that they were using to base their loan structures on, not being accurate and being manipulated effectively by co-conspirators, I guess, or others that were working with them to create these valuations that weren't real. A lot of lenders were affected. Some were very highly affected because they had too much concentration with that one borrower. I think that has been happening forever. That's not new. But I think it was a wake-up call to the industry that we really need to take a close look at our practices, our policies and procedures, and just general industry guidance on some of these issues, and specifically related to valuations. Like, if you're lending on something that hasn't been completed yet, you really need to have a pretty decent idea of what it's going to sell for at the end of the day. The market's going to make you wrong most of the time, but hopefully only wrong by a little bit if you did your work right. If you have bad information coming in from a third-party appraiser or valuation company, and there's fraud and manipulation there, it can really be dangerous, and dangerous not only for the firm but for the industry. So I think as an industry, we are really trying to address that issue. I'm a member of the National Private Lenders Association. Shout out NPLA. I think you guys are really great. I sit on the legislative panel for NPLA, but we've got some new leadership. Eric Abramovich from Rock Capital is the new president of the NPLA, with my good friend Jeff Tennyson stepping down earlier this year. Eric is very keyed in on this issue and is really driving a lot of work at the industry level to address, how we can create better processes and standards for valuations, and some checks and balances there to help make sure that the industry remains healthy and thriving moving forward. So I'm very encouraged by that. I think it's not an easy problem to solve. There's a lot of challenges and nuance to it that we have to think through as an industry. But I think that thought process, that work is being done, which is exciting, and I think is the reason that we have these industry associations. So happy to be a part of that. And I'm certainly encouraged with, the velocity of those conversations. It's not a problem people are sitting on, which is great. I do think, look out across the country. I mean, Renovo, I wouldn't call us necessarily a nationwide lender, but we do lend in, call it 40 plus MSAs, markets. I think if you look across that landscape, there are some regions of the country that are, a little more challenged than others. And I think we've got, some inventory issues where you have inventory sort of building up in a handful of markets, which is, creating softer sale market. If you're an investor and you buy something and you expect it's going to sell for X and you get to market and it turns out in order to sell it at X, you might have to leave that thing on the market for 90 plus days. That's a problem because you as an investor count on the velocity of capital. You want to turn that money into a new project and continue to earn returns on that for you and your investors. It's a big problem when those projects stall out. Additionally, pegging a price is tough. So, you have to assume, I think these days, that projects are probably going to take a little bit longer to sell at, sort of the top of the market value. If you have kind of a range of value for your asset, if you want to sell it at the top of that range, you might have to leave it on the market for a while to find that perfect buyer. If you are willing to sacrifice some profit and sell it a little bit lower than what you thought, you might be able to sell it faster. And that's a decision point that a lot of investors have to grapple with. And everybody kind of has a different perspective or different needs in their business. So, but I do think in some markets you're seeing it more than others. Markets like a lot of the Texas markets where, I sit in Austin, Texas today. A lot of our Texas markets are experiencing a little bit of an inventory buildup. Florida, I think you're seeing that as well. You're starting to see it in the Carolinas, specifically kind of the Charlotte, Raleigh-Durham area. That all comes out of the incredible influx of residents that happened during COVID. Those three places, kind of the Carolinas, Florida, Texas, were havens for folks that were fleeing markets that either they didn't want to live in anymore because of weather, like, the Northeast, folks wanting to get out of the cold, finally having the opportunity to kind of do that and not have to completely up in their lives and get a new job. They could keep their same job, move somewhere else, and they could continue to move through life. The Florida, Texas, North Carolina markets are places that a lot of those people went. Warmer weather, maybe more favorable politics, depending on where you come from. But, COVID was a very challenging time for all of us. There was a lot to deal with. And so, some people wanting to get into a more relaxed, less restrictive environment, et cetera. So you had all these people moving into these markets. It artificially pushed prices way higher than they should have been because you had a spike in demand without the supply to back it up. Now we're having to kind of go through that process where some of those folks who moved, they got called back to the office. Now they got to go back. Things like that, people, and then generally kind of pricing getting out of hand. And home pricing is not a super fluid thing. When pricing goes way up, everybody now assumes that their house is worth that. If they go to sell it, there's a lot of friction for them to sell it back at 2019 prices when they feel like they've gained all this value, even though it was maybe on paper value. So you have a hesitance to sell, and then you have all this new supply because investors are seeing the demand and they're pouring capital and doing projects that is increasing the supply as well, right? And there's a lot of other dynamics. I'm not an economist. I just play one on the internet. Just kidding. But those issues, I think, have now resulted in now we're kind of having to deal with the outcome or with the results. And a lot of that, I think, has just created some additional headwinds in some of those markets. I think there's still great markets to invest in, but, investing successfully is a very hyper-local thing. So you've got to really know the markets you're in. From a lender's perspective, we've seen days on market going up in those areas, maybe pricing softening. It's just something for us to keep an eye on. But for all the investors out there, I think it's really important. This is a good time to double down on your diligence, making sure you're keeping abreast of the market, what's going on, and making good decisions. And in some cases, that might mean not doing as many deals. Really focusing on the projects that you have high confidence are going to return, give you a great return. Doing kind of so-so deals may or may not be a good strategy in this market, but that everybody's a little different. Everybody's situation's a little different. So, more to unpack there, and we'll touch on in a moment. But, tariffs and immigration policies, that was a big story. Last year, January, Trump gets inaugurated for the second time and comes out of the gate swinging, right? And threw out a lot of, really upended a lot of the order that you're seeing, the kind of geopolitical order. But he came out strong with tariffs, which he's been saying he's going to do for a long time. He did it. to his credit. The guy was willing to follow through on that one. And and then you've got the immigration thing, which, as we sit here in January 2026, is a very hot issue with what's going on in Minneapolis and other parts of the country. So a lot of people, myself included, really thought as those things were being announced and actually enacted, that we would see some pretty material impacts to our business and to the business of our clients. Specifically, you look at prices of inputs, right? Lumber, we were doing that whole thing with Canada about lumber. Trump walked that back. A lot of the parts, a lot of the fixtures and certainly appliances and things like that are made overseas. With the tariff impact on the prices of those goods create problems in the budgets of our clients. That was something that we were keeping an eye on. Just availability of product, being able to get that washing machine, from overseas, that was all a question. And then of course the immigration thing, really hits the labor side of the equation. Are people going to show up to work on job sites that might be impacted by this? Are people going to leave because they don't want, to deal with this looking over your shoulder thing or being in fear? What happens if somebody who's working on a job site's mother gets wrapped up in something like an ICE raid? How's that going to impact his ability to come to work consistently and execute a project? All things that I think we expected to see some kind of material impacts on. And quite frankly, as of now, I don't know that that's really been the case. I think that there have been impacts, no doubt. Certain investors, I think in very selective situations, have probably felt some impact. And I think general inflation is, still very relevant. We've not beaten inflation. Tariffs amplified that a little bit, but what I think you saw a lot of companies, manufacturers, and retailers really kind of eating the tariffs to not interrupt their business and their deal flow or velocity of sales in terms of goods and goods in particular. And so you didn't see this massive spike. Now again, you did see it in certain situations, and I've heard a lot of anecdotes, but I haven't seen it really impact the sector, right, very much, which is a good thing. Now I don't know that will be forever. Those things often have lagging impacts. And so, are we through with those issues? I don't know that we are, but I think we can sit here in January of 26 and say, the impact in 25 was not as severe as some had feared. And I think that's positive. It's definitely, if you see a massive spike in labor costs and materials costs, yes, that's going to put a damper on what our clients are able to do and the profits they're able to generate from that. So, we didn't see that. That's good. I think we still need to be very vigilant about, looking at those things and managing. Certainly managing costs is hugely important, especially in a softening price environment. So I think that's going to be a story to continue to watch. One of the big stories of 25, I think is artificial intelligence. AI really came into our lives in a big way. It's been around on the periphery for a while, but it definitely hit the mainstream in 25. I think that's guaranteed to escalate in the future. So I think that we're just at the beginning of that trend. But a lot of people I talk to in lending and a lot of the client base that we work with, I think everybody is trying to figure out how do we incorporate this AI thing into our business to create efficiencies, lower costs, et cetera. I think we're still very, very early in that process. I think there's a lot of good ideas coming out, some very solid applications. I'm now using some variations of AI for various tasks that, used to take me quite a bit of time. It's now, kind of allowing me to create some efficiencies there and really focus on creative thinking, relationships, et cetera. That's all very positive, but I think we're still, very early in that process. So that's definitely one to watch. We've also seen some, and I'll kind of wrap this up, but I think we've seen some, increased scrutiny on the behalf of investors or loan buyers in our space. Many lenders rely on a third party to buy the loans that they're creating or that they're originating. And then those kind of go into, kind of Wall Street, typically into securitizations, which are bonds, over to the balance sheet of insurance companies and so on and so forth. So that's an important liquidity engine. And as a result, the loan buyers kind of tend to be sort of gatekeepers, right? They sort of set the parameters of loans that they will buy, those parameters are driven by, aspects that will help them sell a bond filled with those loans down the line. But they're kind of in an important spot, and they have the ability to impose discipline on the industry. If you kind of just give everybody blank checks, they're going to go out and some people are going to go out and write loans that don't make a lot of sense. And that is something as an industry we really have to avoid. I think that the loan buyers are in a perfect position to impose some discipline and create standards, that help our industry stay out of trouble. While things are going really well and there's a lot of liquidity in terms of capital coming in, that story can change very quickly if the narrative changes. And if the narrative changes because you've got a tremendous number of loans going bad, going into default, having to go through special servicing and foreclosure, et cetera, if the loan performance suffers, that pain gets felt by the bondholders and the financial institutions who issued those securities. Then it starts to really impact the flow of capital down into the space. Like liquidity can dry up, and that can be very, very painful for an industry like ours. So, that note is an important one in terms of, investors, loan buyers starting to be more, apply more scrutiny to the basic underwriting assumptions. How was the valuation done? Stress testing those valuations, using their own models. What should underwriting of a borrower look like? How deep should you go? How well do you know the client? Have you been to the project? Like, these are all things that any really good lender should do. We certainly do that. We know our clients very well because we lend locally. We meet them face to face all the time, and we visit their job sites, personally a lot. So those are important things. You need some form of discipline. And one thing that is really great in many ways about our industry is we're unregulated by, kind of the bigger banking. We are not regulated like a bank. Federally, there's a lot of reporting, there's a lot of hoops they have to jump through, and it makes them a lot less nimble. And, we need that flexibility. So, our industry in private lending is not regulated like a bank. If we mess it up, we will invite that regulation. So what we need is to self-regulate and create some structures, and we need that discipline. And I think the loan buyers and the investors acquiring these loans and then securitizing, those people are in the perfect position to impose that. Wall Street's not always great at sacrificing money for a longer term good. But we hope that everybody has enough skin in this game to really protect it. And I think that means, imposing some more discipline. I think additional scrutiny on underwriting and things is a good thing. It might be annoying for lenders that are, having to stop and maybe delay a closing because they've got to get a bunch of documents to their loan buyer to make sure that they've got a takeout. That's annoying. It's inconvenient. It's not great for your customer, but if you're doing things the right way, it shouldn't be that disruptive. And I think it's important that people who aren't doing it the right way or aren't doing all those things to the appropriate degree kind of get forced into doing it. Because I think in the long term, it's really much better for our industry to have everyone making good loans that perform and keeping our investors happy. Because if we don't do that, we're going to have much, much bigger problems. So, take the lumps, work on your process. You got to sharpen your tools. But at the end of the day, I think it's a good thing. And I think that's something I started to notice last year that I think is an important one to note. Moving on to 2026, I think we're going to have a lot more of the same, to be honest. I go to a lot of conferences. I listen to various people pontificate on the industry and the economy and geopolitics. And, I talk to a lot of economists, and I think the theme I've heard consistently is, we probably have a lot of the same things coming down. This administration is not getting any less volatile. I mean, I think we've seen now through 5 years of Donald Trump that he's kind of capable of saying and doing a lot of things, whether they kind of make sense to you and me or not. He's willing to shake things up. And I don't think that's going to change. I think that's in his nature. So, I do think that we're going to continue to see substantial volatility. And I think that's going to keep us all on our toes, which again, maybe not a bad thing, but we do need to stay vigilant and be really paying attention to what's going on. So I think we have a continuation of a lot of these themes. Political volatility, probably going to pick up significantly between now and the midterms. 2026, we have the midterm elections. Feels like it's kind of a make or break thing for this administration that they retain a majority in both sides of Congress. I think they're going to pull out all the stops. I think there's going to be a lot of desperation. It's going to be, I think there's some people that feel like their lives are on the line. Their freedom might be on the line. And people will do wild things when they're backed into a corner with the potential of losing their freedom or losing their job, I guess. So I think things are going to get pretty interesting as this year progresses. I think we all need to be prepared for volatility for sure for the next 3 years. But I think this year in particular, it could very well hit sort of a crescendo around the midterm. So buckle up, I guess, is the note there. With competition heating up, I think the war for talent from the lending perspective, well, really everywhere, but as a lender, and I'm very focused on talent, bringing in amazing talent for our organization at Renovo. Talent war has been on for a little bit. It's not new at all. This industry has been doing really well, and that creates high demand for talented and experienced people within our niche industry. I think that's going to continue to be, a very interesting story. I think with the amount of capital coming in, a lot of people are feeling very confident. A lot of, I think, folks that maybe were small to mid-sized lenders in the past are really making plans to leverage their available capital to grow their business and grow their footprint. Hire a bigger team because they've got the money to put out, right? If you don't have the money, it's hard to do all those things. If you feel like you have the money in your back pocket, then you can be a lot more aggressive. And I think, we're seeing that on the talent side, and especially in markets that have remained very strong and resilient. California is a big one. We have a big project to, go into California. I think we have an amazing opportunity for the right person. But it's been tough to find that right person. And I think the main reason is that this market is creating a lot of friction to switching. I think that, the switching costs are very high, to use kind of a tech industry term. If you're a successful loan originator in one of the bigger shops in California, like, you're probably not hurting too much. You're making loans. You're not in a situation. Now, there might be things about the firm you work at that are annoying or kind of aggravating or inconvenient, but as long as those checks keep coming in and you're able to close loans, like, those things don't typically add up to enough pain for somebody to think about, okay, I'm going to leave this place. I'm going to go to another lender who's, and as much as they tell me how great they are, I don't know until I get there. And I'm going to probably have to start over in terms of building my book back. I'm now going to probably have to leave a lot of my customers because of non-solicit agreements that are enforceable in most markets. Even if non-competes are unenforceable in places like California, non-solicits are still in play. So if you're going to leave and have to start over, you got to either have a tremendous amount of pain in the place that you're at, or there has to be a lot of confidence in the new firm. But without the pain, it's tough. So I think that, if the market continues to cooperate and continues to be pretty strong, I think prying away really, really top talents can be tough. Not impossible, and people have their own motivations for sure. But it's going to be tough. It's going to be uphill running for a bit. I think that will continue to be the case unless we see a real shakeup in the market. If the real estate market wobbles, if liquidity really could be the big one. That one tends to drive a lot of issues. If smaller firms no longer have access to as much capital, they start really having a hard time closing all the business, and then you have originators that know they're leaving money on the table because their firm can't back them up. Then you see a lot of movement. Right now, in a lot of markets, I don't see that. Most lenders are pretty healthy and at least have a lot of access to loan buyer funds, even if they don't have a ton of balance sheet capital. So, I think talent is going to be tricky. I think, we feel like we're really well positioned to provide and offer things that a lot of people cannot. So we feel good about being able to kind of pick off some really good talent here or there. But I don't think it's reasonable to assume, even if we wanted to go and replicate, we have probably 50 originators on our team. And if we wanted to hire another 50 at that caliber, like that would take years. It would be very difficult to do that. So I think we have to take that into account in our planning, but we will continue to be aggressive. I think we've got a lot of things that originators value, and consistency and extremely good execution and an amazing culture are things I think a lot of people want to be a part of. So talent's going to be an interesting story. Certainly here at Renovo. Maybe I'm just talking to myself, but I'm sure there's others out there that are feeling that same pain. Maturing and evolving AI tools, industry-specific applications. I think that's an ongoing theme. People are going to continue to find ways to utilize artificial intelligence to create efficiencies, improve margins, things like that. And I think that we're going to see a lot of innovation in the next year around those things. I think people are building things right now that will be coming to market. And I think there'll be some really cool things to look through in terms of how we can, implement AI in our businesses in a creative way. I also think AI has the potential to create a lot more headaches for us. As many things, I think, as many problems as it can solve, or things it can make, it can do faster and maybe better than humans. It's also going to be a very powerful tool for people who are interested in deceiving us, aka the fraud issue. As the AI gets more and more sophisticated and people have ways, have time to work through how to use it, a lot of people are going to use it for good. There's always some people that are not going to use it for good. They're going to use it for bad. And I think the ability of AI to make our jobs more difficult in terms of spotting fraud, the sophistication, the complexity of fraud attempts that could be to leveraging AI, I think is going to continue to increase. And I think we're going to have to be really on top of that as an industry and as a society. I think that problem permeates the whole thing. But certainly from our perspective as a lender, fraud is a big issue, big challenge. And I think AI is going to make it even harder. Now, of course, we'll put AI tools in place to combat the fraud, and then you have AI trying to trick AI, and that's going to be a whole thing. My head almost just exploded. So we'll see. It's going to be an interesting one to watch, but certainly something to pay attention to. I think the lenders that find ways to implement AI without losing kind of their identity, I think they will have advantages, in terms of what they're able to do. If you can cut costs out of the process, then you can offer a cheaper loan and be more competitive and gather more business. I think those are obvious things. There's a lot of nuance around that. So, it's not a panacea. And, I think we think about AI in terms of how can it enable our incredibly talented team to do more, better, faster, not necessarily replacing them. I think it's important that we keep our culture and that we keep the really special things. And our business is very high touch. It's very human driven. That stuff is not going to go away. But, for others who maybe aren't as focused on relationship or high touch, there's lots of ways I think that you can be implementing AI, and in those segments, I think you're gonna see some winners and probably some losers, right? And so that'll be an interesting one to watch. The fact that this technology is not just available to the most wealthy firms in the country. I mean, historically, like really cutting edge technology has kind of been dominated for a while by the really, really big firms that have massive budgets and all these engineers. Like now you got kids in their basement writing code by talking to their computer in plain language. I mean, there's a lot of democratization of that. And this technology is not only available to the largest firms, it's now available really to almost anyone who's willing to put the time into it. And so I think that democratization of that technology is going to be a super interesting story. Let's talk about rates. Higher for longer. I just got back from CREFC, which is a commercial real estate finance conference in Miami. All the experts, all of the economists, like everybody was kind of talking about, hey, higher for longer is the theme we continue to see. With all the work that, the administration is putting into lowering mortgage rates through cutting the Fed funds rate and maybe bringing back some quantitative easing, they're doing just as much damage to the other side of the equation, which is sometimes more important, which is spreads. Spreads are really the amount over the kind of base rate that investors require to take on the risk. So if you have people buying bonds, US treasuries, how much do they require in terms of return in order to accommodate for the risk? The more we do unpredictable things, the more we turn our backs on allies and upend the world order and have these issues that we're having at home regarding immigration, the more that the broader markets see risk in investing in the US. And when that happens, the return they require to buy those bonds goes up, which fights head on with the effort to reduce rates. It actually, you can lower the Fed funds rate and have mortgage rates go up because the bond market says, I think that there's things to be concerned about and I need more of a premium to buy that bond. And that's a real problem. And I don't, the messaging, this stuff around the Fed, with the administration's efforts to cut rates kind of now bleeding into some kind of campaign against Jay Powell. That's stuff that other people outside of the US really see as risky or indications of risk. Those are not good. So, I think there's always, this administration is going to have that push and pull. They're going to try to use force to enact their objectives, like kind of forcing the Fed to cut rates and all of the manipulation that seems to be, maybe it's not outright manipulation, but there's a lot going on there. For all that effort, they're really just sending signals to the market that, there's a lot of volatility and kind of anything can happen. And what you used to be able to count on in terms of norms is no longer. And that's all risk. Uncertainty equals risk. And so I think those things are challenging. And I'm very hopeful that, we'll kind of get our arms around that and maybe we'll have some calming down. But I don't know if that's a reasonable expectation. I think as a business, people running businesses, I think need to be looking at what's the downside on all this and really paying close attention. There's a lot of attempts by the administration to impact affordability. We kind of talked about this primarily through executive orders or executive actions that bypass Congress. Probably won't have a huge impact unless, hedge funds become forced sellers, right? Like if you think about, this is all as it relates to housing prices, right? So Trump is now really big on, hey, we got to make, he's learned that affordability is the thing that Americans care about the most, and that's going to really drive the results in the midterms. So now he's got a lot of things coming out. He's just kind of randomly tweeting things all the time about different ideas on how to impact housing affordability. That's fine. Like this whole idea of hedge funds and institutional investors shouldn't be able to own thousands of homes. I mean, I have no problem with that, really. I don't think it's really making a huge impact on the market. I think those hedge funds and institutional investors are only really moving the market in a few very specific places, primarily the Southeast. And so I don't think it's like a big problem, nor do I think, well, whether it's a big problem or not, I don't think that banning institutions from owning single family homes is really going to move the needle that much in terms of affordability. I think it might have impacts in very specific areas, neighborhoods. I don't think it's going to have any kind of national impact or even really state impact. So I don't think that's a big thing. I think where it could be an issue, at least in a short span of time, is if the administration forces those hedge funds to liquidate those homes. If you have a forced sale situation and you have an institution that owns 50% of a neighborhood and all 50% of those homes go on sale at the same time, that's going to bring prices way down. That could be problematic for people who live in that neighborhood or in that county. I don't know that it's going to have a big impact to, everybody. I don't think it's going to have a big widespread national impact. Again, what do I know? But that's kind of what I think on that one. And that's maybe some of those points are maybe more towards the borrower side. Lenders like us, I think there's a number of things that are going to be important. We're going to need to focus on fortifying our capital structure and the relationships with capital to ensure liquidity. I think that, the downside of any of these cycles is kind of a liquidity pullback, right? Investors go, man, that space is too risky, or I made an incorrect assumption. I'm going to stop allocating money to that space. And Wall Street's a follower market. So once one or two people start doing that, everybody kind of jumps on. And then you have this mass exodus of capital, which can create real instability. That's something to watch for. And I think, we like to say, like, there are kind of, running your business and optimizing all these things, it's all great. But at the end of the day, like, you got to figure out, like, what could kill me and how do I make sure I don't die? Like when COVID happened, the game changed from how do I grow my originations, like I did last year, to how do I make sure I don't die? And the ones who survive through those liquidity crunches, they're the ones that can, reap the reward of all the opportunity that shows up after things kind of flip. But liquidity is the lifeblood of any lending organization. And if all of a sudden you don't have any capital to go lend, you can't make loans. And if you're not making loans, you're not making revenue, because we make money when we close a loan. Renovo services loans, so we make money all the time, but most firms don't, right? So when you can't originate loans, all of your revenue goes away, and now you got to figure out how to pay all these people and keep the lights on and all that. That can be a death blow, right? So I think just for lenders, making sure that you create redundancy in the relationships, and if you're selling loans, you need multiple sellers in case one has an issue that you can pivot. I think it's also important to start really building out different verticals or silos of capital. Selling loans is great, but what happens if the loan buyers go away? Well, then, securitizations are great until the bond buyers go away, or, something like that. And then, taking custody of capital, raising balance sheet capital through a fund or a REIT or whatever, that's another kind of sticky way to do it. I think you kind of have to do a lot of those things. You need multiple buckets of capital, so that if there's an issue in one, you can pivot, and having capital under management or balance sheet capital available that's sticky can be really, really beneficial if liquidity dries up. So I think that's another one. I think this is a good time. A lot of these lenders are growing pretty quickly, a lot of revenue. I think they need to be deploying that revenue into how, diversifying their capital structure. Going to be very, very, very important. I think for lenders, like, having boots on the ground and intimate connectivity to projects and sponsors is going to continue to be more and more important. With the ability of AI to spoof people's image, voice, doing business entirely by the phone or through Zoom is not nearly as kind of predictable or safe as it used to be. Now, it could be a chatbot on the other side, or who knows, right? But I think that, so the technology piece with AI kind of making, things a little bit more hazy. And then you combine in sort of a softening market, a lot of interest rate movement, or, various just, all the different things that impact our borrowers. I think having on the ground representation, people who can see projects with their own two eyes, not through pictures a borrower uploads, people who are meeting their clients, getting to know them personally. I think these are important from a risk management standpoint. I also think that as we continue to go deeper with AI, our world continues to be more and more online. I think people are really interested in relationships. I think that currency is coming back. I think people want to deal with real people. Just like anyone, I think we have an innate need to feel seen and heard. It's a lot harder to do that for your customer when you're 1,000 miles away in a boiler room, just hammering calls all day. I think showing up, meeting the clients, showing up to the job site, taking people to lunch and dinner, I think those things that used to be kind of par for the course for doing business, I think those things are coming back. And maybe I'm biased because that's kind of the way we run our business and that's what we value. Doing more business in person and having more connectivity to projects and sponsors, I think will be a winning formula. Not as easily scalable for sure, but I think we've proven at Renovo that you can scale that model if you do it the right way. And this is not really a pat on the back for us. I think it just happens to be that's what we think is the right way to do it. It's how we like to interact with people we work with. And so we feel like a lot of clients agree with that. And I think the results would show that that's true. I feel like that's going to continue to be a theme going forward. So something to pay attention to. I think the industry definitely has to continue to improve best practices. And this is something that I think we're doing a good job of. The American Association of Private Lenders, AAPL, and National Private Lenders Association, NPLA, both represent the private lending space, which we live in. I think they're both doing a good job. I work very closely, with the MPLA on a lot of those initiatives, and I'm happy with the work that's going in. I think they're appropriately identifying risks and things that could have negative impacts on the industry. And I think they're taking a proactive approach. Whether the things they do work, how to execute and implement those things, those are all other questions. But I think that there's a lot of good work being done. I think that needs to continue. I think we need to double down our efforts. Regulation in our space is a concern, could be very disruptive. I think we need to really do a great job of self-regulating if we want to avoid Congress and a bunch of people who do not understand how this business operates to come in and tell us what to do. So I think, being disciplined, sometimes we're going to have to say no to opportunities that could result in revenue, but if it's for the betterment of the overall, your company's overall performance and portfolio performance, I think those are things that people need to be very serious about. I think anybody who's making loans based solely on the criteria that they think someone else will buy this loan from them and not looking at the underlying risk, taking a critical eye to credit, asking questions, digging, looking for inconsistencies. If you're just making a loan because you think that the next sucker will buy it, and you don't believe in the loan you're originating and wouldn't want to hold it, you shouldn't make it. You shouldn't make that loan. I believe that deeply. I mean, it's the grandma's money test, right? If my grandmother only had $100,000, would I encourage her to put that $100,000 into this loan? If the answer is no, you probably should take a very hard look. I mean, that's a kind of an extreme example, right? Grandma's last 100 grand, but I think that's a good lens, right? Or some version of that is a good lens. Like, would I put my own money in this? Would I put my parents' money in this? I think we need to just really bring a lot of discipline to the space. I think the associations are doing a really good job of the right messaging there. I think they're taking a proactive approach. And, I think we as an industry have to respond, take action. And I think if we do those things and we work with our industry associations and get involved, I highly encourage people to get involved at the very least. If you're in the space, if this is how you make your living, get involved. That's going to be helpful in the long run. So those are all really things that are important for the lenders. On the borrower side, I think borrowers are going to need to get really sharp on their numbers, right? In some markets it is challenged. I don't think there's not a lot of markets where stuff is just flying. I mean, 2021, houses didn't last the weekend. That's not happening, very many places, if any, that I'm aware of. And I think you have a lot of these impacts from, things from COVID that are kind of coming back around. We're, having to pay the bill on some of these things. I think there's still stuff that's going to, continue to provide headwinds. I think, days on market assumptions. I think if you're in the multifamily space, people used to underwrite, hey, I'm going to be able to raise rents 2-3% a year. Well, I don't know if that's a good assumption anymore. Like using some of those historical assumptions in your underwriting and deal evaluation, you probably need to go back and rethink all of those things in light of today's environment. And listen, that advice to some people is going to sound very obvious. Like, of course, that's what you should do, because that's what being good at business is about. You got to always be testing, and not everyone does it that way. So, I think for especially borrowers of ours or people that are like them, small business owners, they don't have a CFO sometimes, and they don't have like all these professionals around them that went to business school helping guide some of these decisions. It could be a guy who, used to be a contractor and now he started his own flipping business, and he might be wildly successful, but, not all these guys are insanely sophisticated, and that's not a knock on the industry. So many of them are amazing at that. But I do think it's a time to be very vigilant, to to double down on the, kind of the stress testing of your deals and being very selective. It can only take one deal to sink your whole business, right? So, you want to avoid those really bad ones. And I think you do it just by being more diligent around, evaluation and making sure you're doing the right projects, making sure you have the right partners, suppliers, the right contractors, right? I mean, you just have to really get sharp. This is not an environment where people who are kind of half-assing it are likely to succeed over time. Anybody can hit a couple lucky home runs, but succeeding and sustaining that success over time, I think, is going to require being very, very sharp, really approaching it like a professional and making sure you're dotting your I's and crossing your T's. And I think people who do that will do very well. They may not have a banner year in 26. They might, but they might not. But they're going to be alive, and they should be able to keep their business moving forward. The people who don't do it right, those folks might be looking for a different job in 27, right? So I think it's just really important for the survival of your business and your team that people really get sharp on their numbers and are, I think the right word would be disciplined about the deals they choose to take on, right? Don't have to do every deal. I think borrowers need to stay well capitalized. That's going to be important. If days on market go up unexpectedly, you've got longer holding periods. You need the capital to get through these. And this is something I think is really important. We've seen, because of some of the competitive dynamics I talked about in the beginning, we have seen quite a bit of very high leverage products coming to market. And they've always been around, but and when I say high leverage, I'm talking about 95% of cost, 100% of cost, where the borrower has little to absolutely nothing in terms of their own money in a project. The lender is fronting all of the costs. The borrower's money in the deal is what we like to call skin in the game, right? If you don't have any skin in the game, then you're a lot less emotionally tied to the outcome. You're more likely to walk away if there's any sort of hiccup, because you're not losing anything personally. You're just losing this one deal. That is a problem, right? I think that product in terms of everyone and all this capital trying to find deals and deploy, people are really overreaching with the leverage in particular. When you have a borrower that is doing 20 projects a year, but doesn't have any cash to be able to put as a down payment on the next project, like that's a red flag, right? Like you don't have enough money to do another project. Even if you had to put 10 or 15% in, you probably don't have enough money to do the projects you're doing now. I think that investors, borrowers, developers need to really, just because the product is out there doesn't mean it's the best thing for you to do. And I think the behavior aspect, behavior is driven by your interests, right? Like, how much self-interest do I have in this? And that's going to impact your behavior. Less so there, but more so on like having the resources to get yourself out of trouble, I think is going to be important. If something unexpected happens, you need capital to have, that you have access to liquid cash that you can go out and solve those problems to then fight another day. And I think there's a lot of investors out there who are running their businesses incredibly thin on the capital side, like very little money in the bank. They're putting everything in that they have into the projects that they've got going on. If every cent that you have is in your, say, 5 projects, I would argue that you cannot afford to do 5 projects. Maybe you should do 4 projects and have some cash, or 3 and have some cash. I think that's a trend I've been seeing that I think is kind of heating up in the wrong way. Like, way too many people that are reliant, like, I need 100% loan to cost product or a loan on this deal. If you need it, then you probably shouldn't have it. And I'm making a broad statement. There's a lot of our clients, and we do offer some 100% financing for extremely well qualified borrowers. We have a limited, it's not like we're just spraying that all over the place. We're very selective. That's, I think, the right way to do it. I think it's an important product. It's a valuable product to have. And for the right people, it can be a tremendous tool. In the hands of the wrong investors, it can be a very big weapon. And oftentimes that weapon is used, the impacts are felt by the investor themselves. They put themselves in a spot they can't get out of. I don't think that's a good way to run your business. So I think just really being thoughtful about that. It's a trend I think we have to be really paying attention to as an industry, because I think that product, that amount of leverage is being overused. And those are the kinds of things that can create systemic weakness that bubbles all the way up to the capital side of the equation and creates the liquidity problems that we're all trying to avoid. So I think that's very important. Borrowers need to understand the role they play. Lenders need to understand the role that they play, which is the lenders need to be the gatekeeper. The borrowers, yeah, they're going to take what they can get. But I think, building a business to last that, is sustainable is something everybody should be trying to do on some level, even if you want to sell that company one day. So I think that's important. I mentioned being selective about deals. It's okay to pass. It's okay to pass on a loan or a project. If you feel like the profit margin on that is thin, and then you also have assumptions that might be a little optimistic, that's the recipe for a bad deal right there. Don't do those deals. I talk about it in terms of my own business planning, my own, like, how I'm planning my goals. Like, I think this year is, really realizing the power of no. There's a lot of power in saying no. For customers and borrowers that are out there doing projects, like, sometimes it's the best thing you could ever do is say no to a project. You don't have to do everything that just kind of pencils. I know there are other motivations, keeping your crews busy, certain things like that, right? I get that. And those are going to be factors. But I think just paying close attention to that aspect of the business, like making sure you're being responsible and not putting yourself at undue risk. And I touched on this also, but I think picking the right partners, really spending time deepening relationships with your suppliers, including your lenders. I think that in a market where you have an unusual amount of liquidity, like you have a huge amount of capital, that's not likely. Well, I don't think you should count on it lasting forever. Right now, every lender under the sun has effectively an unlimited amount of capital. Great. But what happens when, not if, but when you have a liquidity pullback? It might not be a crisis, but if liquidity pulls back, guess what? They're gonna, the guys that are deploying money into these lending businesses, if they decide I'm not gonna put as much money into that same sector as I used to, who are they gonna stop, giving capital to? Is it gonna be their 5 best counterparties that deliver the highest quality loans, that have the fewest issues, that provide clean data tapes and are obviously very, very sharp and good at what they do? Or are they going to pull capital from the bottom 5 that are always late, don't communicate well, have a lot of poor performance and delinquencies within the loans that they produce, are generally not as sharp and don't seem to be as on the ball? Yeah, that's who they're going to pull the money from. And if that happens and you're working with that lender, then you now have no access to capital or extremely limited access through that one lender, but you were working with somebody that was giving you the best deal of all time. Yeah, it was the best deal because they weren't doing half the stuff on the back end that they should have been doing, which is why everybody else who's good at this charges a little bit more. Like, those are the kinds of questions I think people need to be asking, because if we do have a liquidity pullback, you're going to see a number of these kind of more upstart lenders, people that are just not as sharp. You're going to see them really suffering, and really who's going to suffer is their clients, the borrowers that are working with them and have not established a network of relationships with other capital providers. Hey, this guy's giving me the 100% financing at 8% or 7%. Nobody can beat that. Why would I talk to any other lender? You talk to another lender because if that guy blows up, then you have nothing. So I think it's important, communicate, build relationships, have a couple or 4 or 5 different lenders that you can work with and create redundancy on that side of your business. You should be doing that for every part of your business. The last thing I'll say on this is, I guess in general, I think for investors, like prioritizing consistency of execution is really important. If you're working with a lender that gives you an incredible deal, but it is a nightmare to go through the underwriting and closing process with them, that says something about what's happening behind the scenes that you can't see. All these other things that you can't see, they're probably not doing those things very well either. I think focusing on people that are consistently there for you, that are very good on and give you a good experience, like those are people that have figured it out. They're masters of their game. I think those are the lenders that you should be prioritizing. And then you look at terms and leverage and other things, but aligning yourself with a really strong capital partner, super, super important, especially in times of volatility when you could see unexpected things pop up maybe more frequently. So I think that's a really important one. And then I guess the last thing I'll say is Kevin Warner, our CEO, talks about this from his own experience working with a bank prior to the great financial crisis when the GFC hit. His bank was having some difficulties, and he had really prided himself on cutting this incredibly aggressive deal with the bank. He beat them up in the negotiation over a warehouse line and got all these really great enhancements and a line that he felt like was, he had won that negotiation. The bank on the other side, they viewed him as, this guy got a great deal, but if things get difficult, who's the bank going to fire as a customer first? They're going to fire the guy that basically, got such a good deal that it wasn't either very profitable or accretive to their business to maintain that deal. So, when the GFC hit, his bank's like, sorry, you got to pay off your loan. And why? Well, why is because we barely make money on this deal as it is. And, now we've got some issues and we got to fire somebody. And unfortunately, you cut too good a deal for yourself. You're top of the list. That same scenario happens at the borrower to lender level all the time. And I think it's really important. People who are really looking to build a long-term sustainable business as a real estate investor, they will take into account that their counterparties like banks, private lenders, contractors need to make enough money for that business to be worth it so that you have lower turnover, fewer, and somebody who's willing to work with you. If the bank has a fair deal, they're going to be a lot more likely to work with you when there's a problem. If you have negotiated your loan with your private lender all the way to the highest leverage point possible, the lowest fees, the lowest rate, all of that stuff, you are a very unattractive customer, right? If the lender's not making any money and you're difficult to deal with, then it doesn't take much for them to go, We don't need that customer. Don't put yourself in that position. That's all. I think that's really the main thing. I think it's a really great lesson I learned through Kevin. It was incredibly painful for him. It caused him to have to shut down his whole business. Fortunately for all of us at Renovo, he started what is Renovo today just after that, using all of those amazing lessons from what was a very difficult period. So we didn't have to pay the price to get that lesson from him. Hopefully somebody has that experience on the other end of this. But yeah, those are kind of all the main things I wanted to talk about. Just to wrap it up, I think a lot of continual challenges with the geopolitical thing. I think we're gonna have a lot of political volatility. I think that's going to impact us in various ways. Some we might be able to predict, others we won't. I think making sure that lenders and investors alike, anyone running a business, is really sharpening their skills, really getting into the weeds, challenging assumptions. Those things are all going to be highly, highly important if something unexpected happens. And I think this is the kind of environment where unexpected things happen more frequently. So I think, taking all that into account, I couldn't, hopefully this didn't sound too doom and gloom, because I couldn't be more excited for 26. I think Renovo, we put ourselves in an incredible position. We are very excited about the foundation we have to build off of. And I think we've got a lot of success coming up that I know our team is really excited for. So I'm very excited. It's going to be hard work. The good stuff is always hard, but it is definitely going to be difficult. It's not going to come easy, but that's a good thing. And I think if we all kind of continue to really stay disciplined, hold each other accountable, work together, we're going to have much better outcomes in the future. So I really very excited about 26. I hope you are too. And look forward to coming back with a lot more great content. We're going to have some great guests, amazing interviews and conversations. And we're going to start putting in more things like this, where either myself and a few others from that have some expertise can kind of sit down and talk about things that are relevant and important for today's environment.
All right. Well, I hope you guys enjoyed this show, the first show of the 2026 season. We got in depth on a lot of different things there. Hopefully, you guys got a lot of value out of that. Would love to hear your questions and thoughts on the episode, or any things that you agree with or disagree with. But, at the end of the day, I think there's a lot of different ways to look at what's happening in the world. I think, we have we think a pretty well-informed perspective, but, there's a lot of different angles to explore. So hopefully this was kind of a good primer and good way to start the year. If you enjoyed the content, please like and subscribe. We'd love to stay in front of you as we bring out a lot more content this year. As I mentioned before, we are going to try to start doing some new things, having some new faces on the show, both from Renovo and from outside. We've got a lot of great guests lined up. So did want to preview a couple new episodes that we have coming up.
Take care.
I'll be interviewing Marcus Kriegler, who is fractional CFO and has done some really amazing things with a lot of real estate investors that we work with and that I know personally. He's a really interesting guy, very sharp guy, and has helped a lot of investors save a lot of money from a tax perspective, but also plan their businesses and really stay on top of the financial side of their business, which can be a huge challenge for a lot of people. So I think there'll be some really cool stuff that comes out of that. And then we're also going to do a really neat series on real estate investor masterminds. So for those who aren't familiar, there are groups, a lot of them. There's big national groups, and then there's, regional groups as well, that really bring people from the investor community together, folks that have similar challenges and problems, that can come together in a non-competitive way and really learn from one another. There's lots of things that everybody's going through, but odds are somebody's already gone through it and maybe has an answer. And so when you kind of put those people in the room together and create an environment where people feel comfortable sharing, there's a lot of really amazing things that can happen. And I've seen it really help investors grow their business significantly, and probably much faster and better than they would have done if they were just kind of on their own trying to do everything themselves. We at Renovo have been members of a variety of these groups. We're very active in 5 different masterminds right now. And we've just seen the power of these groups and what they can do for folks. So we're going to do an episode with Brandon Goldstein, who's on my team and helps cover a lot of the mastermind groups for Renovo. And then I think we're gonna have some of the leadership of some of the different masterminds come on in separate episodes to kind of talk more about their specific group and kind of what they focus on and how they can help investors. I think it'll be really cool. We have gotten a ton of value from these groups. I personally have learned a ton about what our clients do every day and some of the challenges that they deal with, and really kind of getting in the trenches with them and providing what I think is a pretty valuable point of view from the side of the lender. But we also get a chance to really learn more about other aspects of the business and just get to know some of these amazing entrepreneurs in person. So it's been really great. I think that masterminds can be very valuable for the right folks who are really ready to jump in and invest in themselves and their business. So we're excited to bring that to you as well. A lot more great content coming outside of that, but those are going to be a few of the coming episodes here. So stay in touch with us, and we look forward to bringing you a lot more great content in 2026. All right, cheers.